I'm Trinity Chavez for NYSU TV. Joining me today is Ryan Raskopf. He is a partner at Pennant Park. This is the second episode in our video series on private credit investing. We'll be discussing the floating rates loans in this installment. Ryan, good morning. Thank you for joining me today.
Morning, Trinity. Thanks for having me.
Absolutely. Ryan, let's start by talking about Pennant Park's typical loan structure.
Sure, Trinity. So here at Pennant Park, we typically lend money to mid-sized companies. And those companies, they'll use our loan proceeds for a variety of different business purposes. It could be to pay their employees, to buy equipment, to invest in growing their operations, or otherwise just to pay their expenses. As we think about structuring those loans, our loans are usually senior secured, which means that they're backed by all of the assets of the borrowers. So that collateral can include real estate, it can include equipment, facilities, intellectual property. Any asset of the borrower will typically be part of the collateral package that backs our loan.
Now, do these specific loans have a set interest rate or can they fluctuate?
So these loans are almost all floating rate loans. If you think about our usual loan, there's two components to the cash interest rate. There's a base rate, which is sometimes called the reference rate, and that rate will fluctuate. It'll float up and down based on prevailing economic conditions. In our loans, that base rate usually resets every quarter, and that reset will be based on the market interest rate at the time. Then there's a second component of the cash interest that we earn, and that's the credit spread. That credit spread will usually be fixed over the life of the loan. So if you think about a base rate, if it's 5%, and we have a loan with a 6% credit spread, that loan will be paying an 11% cash interest rate at that particular time based on the level of the base rate. The base rate component really makes the concept similar to an adjustable rate mortgage. But you have the fixed credit spread on top of it. And then as you think about over time, the yield on our loans, they're typically higher than what you get on a fixed rate corporate bond. And that's because of two things. One, the credit spread that we're earning in addition to the base rate, which results in a higher interest rate, and fees that we'll earn on closing fees and other fees throughout the life of our loan. And that premium is based on the work that goes into structuring and executing and sourcing our middle market investments.
And now interest rates, they have risen in recent years. How has that impacted the value of your portfolio, if it has?
So rising interest rates are actually a very good thing for our investors. And in large part, that's due to the nature of floating rate loans in our portfolios, like we just discussed. So if you think about the debt of a large company, it typically bears a fixed rate of interest, and that interest rate being fixed makes it very sensitive to changes in the underlying base rate or in the interest rate environment. So if you buy a bond at $100 and that has a 5% fixed rate coupon, if interest rates increase, you can probably buy a bond after interest rates increase, similar risk profile, it may be yielding 10%. And as a result, what happens to the original 5% bond? Obviously, it's less attractive relative to new issues, and so the price declines. But in contrast, our floating rate loans, they don't have that exposure in terms of the price volatility because as interest rates rise, our base rate rises, and those additional interest proceeds, they're passed directly on to our investors. So in a rising interest rate environment, our investors benefit both from the higher yields that they're earning through the higher interest rates, but also from the relative price stability if you look at our loans versus some other fixed income asset classes.
Great. Well, thank you so much, Ryan, for joining me today.
Thank you, Trinity. It was a pleasure.